Excellent. So I think we can start. Welcome everyone to this new event of the webinar series organized by the E-Access Forum on Climate Change, Macroeconomics and Finance. The aim of the forum is to aggregate researchers and policymakers working on topics at the intersection between climate, macroeconomics and finance. In addition to the webinar series, the forum is also on Slack, and there you will find working papers, news, and conference informations. My name is Emanuele Campiglio. I'm an associate professor at the University of Bologna, and I will be the chair of this event with Professor Warwick McKibbin as speaker. So let me now introduce you to Warwick. Warwick is based at the Crawford School of Public Policy at the Australian National University, where he is Vice Chancellor's Chair in Public Policy and the Director of the Center for Applied Macroeconomic Analysis, CAMA. He's also affiliated to the Center of Excellence in Population Aging Research, the Economic Society of Australia, the Asia and Pacific Policy Society, and the Brookings Institution in Washington, D.C. Warwick has published more than 240 peer-reviewed academic papers and 5 books on a number of topics, including global economic modeling, theory of monetary policy, climate change policy, and the economic modeling of pandemics. He served on the board of the Reserve Bank of Australia from 2001 to 2011 and worked at the Reserve Bank from 1975 to 1991. Today, he will give a talk on climate change and monetary policy, issues for policy design and modeling. A paper with the same title by him and co-authors was published in January this year on the Oxford Review of Economic Policy. The event will be structured as follows, as usual in this webinar series. So Warwick will speak for about 45 minutes. Please feel free to pose your questions in the chat or in the Q&A window during the presentation. If these are immediate clarification questions, then I will briefly interrupt the speaker to address the question. I will instead postpone the deeper questions to the Q&A section at the end of the talk. At that point, I will invite you to open your microphone and ask the question directly to the speaker. And if you prefer, I can also do it for you if you signal it in the chat. So before leaving the floor to our speaker, please let me remind you that the event is recorded, and let me launch the usual poll of E-Access webinars. So you should see now a couple of questions appearing on your screen. So the first question, let me read it to you, is which of the following links between central banks and climate change or climate change policy do you find most important for macroeconomic modeling? The 2 main options are the impact of climate policy on inflation expectations or the impact of physical climate change on aggregate output. And the second question is instead, in your opinion, which of the following monetary policy frameworks is most fit for purpose in a volatile climate economy? Targeting the inflation rate, targeting the price level, joint inflation and output targeting, or nominal income GDP targeting. So I will now leave you a minute to answer these questions. So the results should appear soon. If you haven't answered, this is your time to do it. Right, very interesting. So around 62% of the respondents thought that the impact of physical climate change on aggregate output was the most important for macroeconomic modeling, although 34% also replied the impact of climate policy on inflation expectations. while for the most fit for purpose framework, I would say that joint inflation and output targeting attracted most of the replies. So that should give our speaker some food for thought for his talk. And Warwick, thank you again for being with us, and I will leave the floor to you.
Thanks very much, Manuela. Let me just share my screen. Make sure that you can hear me and you can see my screen. If you could confirm, please. And I'm hoping that by the end of this presentation, I may have convinced a few people to change their minds. I'm not sure whether you're going to have a revote or not, but let me move on with my presentation. What I'll be focusing on in this webinar is the link between climate change and monetary policy regime design and monetary policy regime design. What I want to do in the presentation, and it was quite interesting, we wrote this paper, we sent it out to reviewers, and people who are experts in monetary policy said, cut out all the section on monetary policy, we understand that, we just want to learn about climate change. And all the climate experts said, cut out the climate change work, we just want to understand monetary policy. We decided to trim down but keep both aspects pretty well covered in terms of the basics, just so that the climate people understood the basics of monetary policy and the monetary people understood the basis of climate policy. So what I'll do in the presentation, I'll go through some climate basics. I want to talk about the importance of physical risk, transition risk, and policy approaches in tackling climate change. I will spend a little bit of time talking about a hybrid approach, which you may not have seen because in the literature, most people focus on either carbon taxes or cap and trade, but there are other hybrid approaches. I will be presenting some results on real world modeling of climate and monetary issues. So I will introduce the GQ model and show some of the lessons we've learned from using that model in the climate space. I'll then switch to looking at some of the basics of monetary policy. And as many people on this call are central bankers, this will probably be very basic, but I want to make sure that the key propositions for what you need for various monetary regimes is very clearly laid out. And then I'll pull the two streams together and look at the linkages between the design of monetary policy and the design of climate policy regimes. The conclusion I'll draw is that when you consider each policy separately, you come up with a different answer than if you combine the two policies and ask the question, if you're redesigning things jointly, and in fact, I would incorporate fiscal policy as well. I think the three strands of macroeconomic policy should be considered together. I won't talk about fiscal policy today, but that's in some new work that we're doing. And then I'll give some final simulation results. As Emanuela said, this is based on a paper that was published in the Oxford Review of Economic Policy, came out earlier this year. We've done a lot more work since doing this paper, and so I will touch on some of that during the presentation. I should mention my co-authors, Adele Morris, Peter Wilcoxon, and Augustus Panton, who's now at the International Monetary Fund. So the key point on climate change is that both the impacts of climate change, and here I'm talking about the physical risks, and the policy responses to climate change, these are what we call the transition risks, are very important for central bankers and very important for taking into account when designing monetary policy. What I want to stress is that climate shocks, these are the physical shocks, both the shocks coming from trend changes in temperature, trend changes in productivity, as well as extreme events, have aggregate and sector-specific quantity and price consequences. And so here, from a central bank point of view, clearly there's a concern the impact of climate shocks on aggregate prices. But just as importantly, there are some very large shifts in relative prices. And I think central bankers need to be concerned about both the relative price shifts as well as the aggregate price impacts. In addition to the climate shocks, different climate policies will have very different impacts on inflation and the output at the aggregate level, particularly price trends, but also relative price trends, changes in price volatility, changes in potential output, and shifts in aggregate demand. So climate change, both in terms of shocks and policy changes, have some fairly significant impacts on the future volatility in any particular economy. That's fairly clear. I think people who work in this space understand the heterogeneous nature of climate shocks, the disruption from extreme weather events, trend changes in temperature, acidification. There's a whole range of medium to long-term issues. We've seen examples of floods in major cities. We've seen the impacts of droughts. We've seen the impact of very significant forest fires in Australia and the US. And we also have impacts on labour supply. So these shocks from climate change itself can potentially be very large and very heterogeneous. They're also differential across sectors. And so we have some examples here on the screen about in the Dominican Republic, the rotting seaweed of 2015, shifts in permafrost and the impacts it had on infrastructure in Chersky, Siberia, and very large weather events in East Yorkshire. So we've got macro impacts, we've got sectoral impacts. In addition to climate change itself, climate policy is also a supply shock. And how climate policy impacts on different countries and different sectors depends on a number of factors. The stringency of the climate policies, the timing, is it rapid, is it phased in, is it anticipated, how carbon is priced, whether it's a cap and trade system, which I'll talk about briefly, a carbon tax, or a hybrid of the two. It also matters, and I'll demonstrate this, that how the revenue is used from a carbon tax makes a big difference to the demand and supply sides of the economy. And again, as well as at the aggregate level, the outcomes vary by sector, by region, and by fuel type. And it depends very much on what the carbon intensity of different production processes are, what the carbon intensity of different economies are, and what the elasticities of substitution are in production and consumption. So if you're modeling this analysis, you have to have a fairly detailed disaggregation, not of the aggregate economy alone, but of the makeup of the economy across a number of sectors. So I'll just talk very briefly about the types of climate policies that people advocate. Permit trading systems, such as the European system, are well understood. The way these systems work is you pick a target for emissions in a particular year, and then the market will determine the price of carbon in that particular year. Or it may be a window over 5 years, or it may be a window over 10 years. The point here is that the quantity of emissions are fixed, and the market determines a price, and the price will be moving up and down over time. The alternative is the carbon tax. With a carbon tax, you pick a price for emissions, the carbon emissions from a particular process. You then put that into the market, and the amount of emission reductions we get is determined by the adjustment of demand and supply within a market mechanism. So the contrast between the two is a permit trading system generally has a fixed quantity of emissions and a flexible price. A carbon tax has a fixed price and a flexible quantity. Now, there is a hybrid approach, which I'll talk about shortly, and that is an idea of using long-term emissions trading to determine a long-term carbon price in a market, but to use a fixed price in the short term, which looks like a carbon tax, but actually holds the price fixed within a market mechanism. The alternative approach, which actually is very commonly used, is regulatory approaches, where instead of using markets, whether it's a cap and trade or a carbon tax, using direct intervention in various production processes, and I'll very briefly touch on that. Let me just drill down a little bit into the hybrid, because in fact, the hybrid is an approach that you may not have seen in the literature. It has been around actually since the Journal of Economic Perspectives in 2002. Peter Wilcoxon and I came up with this idea. And the idea, well, there's two ways of thinking about it. One is to think of climate policy as like we have monetary policy. So we have a central bank that sets the interest rate, and we want to have a bank of carbon that sets the short-term carbon price, but let the long-term bond market or the long-term carbon market set the prices over time. So the idea was to take the idea of monetary policy and develop a climate framework. The other way to think about it is to think of it as lining up the assets and the liabilities that we're creating in an economy when we put a constraint on carbon. The right to emit is a liability, and emissions are a liability, and the right to emit is an asset. And the thought here is that we want to align the balance sheets of companies and individual households and governments so that their incentives to stay within the policy framework are very strong, and the financing of their adjustment to the climate transition is kept within the corporations, within the household, rather than being mandated by government. And so there's a very large discussion of this at the Social Sciences of Australia website. I refer you to that. how it works is that we take the best idea of emissions trading, that is that quantity of emissions over time is determined by the science, and we want to use carbon pricing for the market to determine where the lowest cost abatement can be achieved at least cost. And so the goal is the government would set an emissions target, let's say zero net emissions by 2050, a path of achieving that within a particular country, and then you create a carbon bank. Looks very much like a central bank in a monetary world, but this is a carbon bank who is responsible for emissions in the economy. What a carbon bank would do would be record annual emissions of all large polluters within a country, create annual emission certificates equal to the government of the target, require all large emitters to hold these annual certificates for any particular year. So they're the assets that are created by the policy, and they have to have them on their balance sheets to offset their annual emissions or the liabilities that they're being imposed on the economy. You then would bundle these certificates, just like we bundle a government bond with coupons for every single year as a return on the asset. In a carbon world, the carbon bonds would have a right to emit a certain amount each year that diminishes over time. And then the final role of the carbon bank is to make sure that in the annual market, they can sell additional permits in this year so that the price of carbon is fixed at a predetermined rate, so that you eliminate volatility in the short-term carbon market, you eliminate short-term economic costs, but you allow the longer-term trading of these certificates to determine future carbon prices. And again, it's a pre-commitment, so the government would give the right to the carbon bank to issue these bonds. This would be a political decision different in different countries. But once these bonds are in the market, you have markets created that trade the annual certificates. That's the right to emit in a particular year. They can trade the carbon bonds, which is the right to emit over time. And there will be futures markets that will be trading future carbon certificates. What you end up with is a yield curve of carbon prices with a fixed price tied down by the carbon bank in the short term, but variable prices out to 2050, very much like we see in most monetary frameworks. The future carbon prices will drive investment, and it provides opportunities for all sorts of abatement opportunities that we may not understand today, but will evolve once the incentives are put in place. So what's the advantages of this type of approach? Very clear long-term price signals to consumers and firms to cut emissions by changing their behavior, and also by investing in new technologies in how energy is used or how emissions are generated, as well as in new technologies on how demand can shift. You get very clear market signals within a country, and you create a political consistency by putting these assets on the balance sheets of fossil fuel intensive industries. They will no longer be arguing against the policy as strongly, because now they have an asset whose value is determined by the continuation of the policy. And you can use this to stimulate the economy. And currently coming out of the COVID crisis, taking environmental goods that aren't priced, giving them value and putting them on the balance sheets of households and firms will stimulate aggregate demand in the economy. So why is it important to worry about short-term price volatility? It's very different. Each of these different regimes, the carbon price regime, the cap and trade or carbon tax, the cap and trade, and the hybrid, have very different implications for price volatility. Carbon prices are more volatile in a cap and trade system. That implies more volatile energy prices. That feeds through to aggregate price and relative price volatility, which are very, very different across the three different types of policy approaches. To give you an example, and this is just one example, and there's a lot of reason why the graph looks like it does. This is the prices of allowances in the EU emissions trading system. And you can see there's enormous volatility in the price of emissions over time. This imparts volatility into energy prices and imparts volatility into overall goods prices. So I'll stop here on the climate aspects. I just mentioned there's a new paper that's just been published, which is looking at more details on how you model the physical and transition climate risk with Roshen Fernando, Larry Liu, and myself. It's available at the Brookings website if you're interested. So now let me talk about what do we think climate change does when we try and model it within a macro framework. And let me very briefly touch on the GQ model. It's a model that's well used in many different organizations. It's published in the Handbook of CGE Modeling. So from a macro point of view, many people think of it as a CGE model, But when you look at the model, it's very much a macro model with sectoral disaggregation. We use it for various questions, whether it's modeling pandemics, fiscal coordination, a whole range of different issues. Each model is developed for the particular question that we're analysing. So we have different country coverage and different sectoral coverage for different applications. It's widely published and it's used by the International Monetary Fund, the World Bank, a number of financial institutions, and has appeared in a number of top journals. So what is a GQ model? Well, I won't go into detail, but it's a hybrid of a DSGE type model that we see at central banks, clear macro structure, but very small in usually within central banks, and CGE models, which have a lot of sectoral disaggregation. And within the model, we track inter-industry linkages and trade, capital flows, consumption and investment. The annual nature of the model, we're restricted, we kind of very high frequency because of the scale, but we have very specific sectoral dynamics. So the macro adds up from the micro underpinnings with frictions. So we have frictions in labour markets, we have quadratic adjustment costs in capital accumulation, we have short-term unemployment, but in the long run, a neoclassical steady state. We have different assumptions about labour mobility depending on the closure. It's very, very standard from a macro point of view. Firms are optimising, they're choosing capital, labour, energy and materials to maximise their share market value. Households are maximising expected utility subject to a wealth constraint, and we impose liquidity constraints as well. We have a mix of rational and non-rational behaviour. And we, as I mentioned, we have the capacity to have short-run unemployment, true structural adjustment where workers cannot quickly be absorbed into their new positions. We also have a full vector of financial markets for bonds, equity and foreign exchange. And we track the flow of goods, services and financial assets across countries. To be very clear, each country in the model has a fiscal rule for government spending and tax policy. This matters a lot when it comes to the revenue issues that come from carbon policy. And we have monetary rules which balance various trade-offs representing the behaviour that we interpret in individual central banks. So key assumptions, it's an intertemporal model. There's a lot of rigidities, but there's also international arbitrage. There's a lot of rule of thumb behaviour. We've got extensive econometric estimation of certain parameters. Not all parameters are econometrically estimated. We have a very large model, 25,000 equations. There's not enough data to actually do it rigorously in a conventional way, but we can talk about how we parameterize the model at Q&A. The model that I'll talk about very briefly that we use for climate change, and this was the same model that was used in the October 2020 IMF World Economic Outlook in Chapter 3. It breaks the world into 10 major countries or regions. These are the major climate change focused economies, plus Australia. Australia is an interesting example because of the carbon intensity of the Australian economy, very similar to the oil exporting economies in the Russian Federation, but a very different level of development and a very different capacity for substitution. A lot of detail, and one of the things you do need for doing climate policy for macro is you do have to break the economy down into the major sectors. You'll notice here we break the economy of each country down into the primary energy sectors. We've got coal, oil and gas extraction. We've got an electricity delivery sector, and down the bottom we have different technologies for delivering electricity. We also break the economy down into construction, mining, agriculture, durable goods, non-durable goods, transportation and services. This substitutability within different levels of production, within different components of electricity generation, across different energy sources, drives the macroeconomic outcomes. So I don't believe you can do this in a single good model very effectively. So we have to shift to this more disaggregated world to be able to use to do modeling for central banks focusing on climate change. Now, just to give you an example of how, when you impose a carbon tax, how does the economy change? And this is important for central bankers. So this is from a paper. I'll just see if I can move this little thing down the bottom. This is from a paper that was published in Climate Change Economics on the role of border adjustments in a US carbon tax. The various permutations don't really matter a lot, except there are two assumptions about how we take the carbon tax revenue. The carbon tax is $25 a tonne in the US, rising at 5% a year. And we have two types of revenue recycling, a lump sum rebate to households and a reduction in existing distorting taxes on capital. And then we look at what happens if you do border carbon adjustments, if you have a policy with adjustments in the US and without adjustments. Now, just to show you what happens across the US economy, again, this varies across countries, but the basic insights are the same. This shows you all the different sectors, the 12 sectors, not the disaggregated electricity sectors. This shows you the change in output relative to what it would have been by 2035. Now, we do generate annual outcomes, but this is just taking a snapshot in 2035. What you can see is when you put a carbon tax into the US economy, it's the coal sector which gets hit the most. And independently of how you recycle the revenue or whether or not you do border tax adjustments, coal takes the biggest hit, gas, and then oil. So most of the impact is on the fossil fuel intensive industries. And then there's the sectors that use those fossil fuels intensively, electricity, gas, oil refining. And then the rest of the economy, the impacts on output are small, but they're still non-negligible depending on the nature of the 4 different scenarios. Now, what happens to aggregate GDP? Well, here we have 4 charts. Now, if you look at on the green line and the red dotted line, this is what happens when you do a lump sum rebate to households. These are the percentage deviation relative to what would have been the case. So this is saying that by 2020, US GDP would be 1% lower than it would have been. So if the US economy was growing at 3%, then US GDP would be growing at 2%. So these are not growth rates, they're percent deviation. You can see that this is fairly consistent across macro models that do climate, is you put a carbon tax on, it increases the cost of production, and in the medium term, depending on how you use the revenue, it reduces output. Now, if you recycle some of that revenue, and this is where the dotted line is, if you instead of just lump sum rebating to households, you reduce distortions on capital, then it causes some investment to come into the economy, and that reduces the GDP loss. What's interesting is if you do a border tax adjustment, and then you recycle the revenue into investment, it actually almost eliminates the GDP effect. So you can't just say if a particular carbon tax will have a particular effect. You need to know what the revenue recycling assumptions are on the carbon tax. Also, I should stress the uncertainty around these lines is fairly substantial. I'm just giving you the midpoint estimates. Now, the second issue is in terms of timing. Here is an example from another paper on the cost of delay, which was ironically written before President Trump became president, because we asked the question, what happens if in 2016, a president came in and changed the US climate policy stance? So what we looked at here was we were trying to achieve a particular emissions concentration in 2050. We said, what would the carbon tax have to be if we start now and growing at a particular rate over time? And this is the profile, it's around $15 a tonne, growing at 5% per year. And then we asked the question, suppose you delay by 2 terms. So suppose the new president has a term of 8 years. What would you have to change? And so this says, well, if you're going to achieve the same concentrations in 2050, you have to have a higher carbon tax if you want it to grow at the same rate. Or if you start the carbon tax at the same level as in the counterexample 8 years earlier, it has to grow much more quickly. So each one of these carbon profiles are very, very different depending on how quickly you're trying to achieve the concentration target. Now, that's on carbon pricing. Non-climate policies, if you start using regulation, it's a complete mess on what the price of carbon will be. Here's an example of what the marginal abatement cost from the Clean Power Plan of the Obama administration would look like across the US. It ranges from $0 to $24 a tonne. Very different across jurisdictions, very different, difficult for a central bank to know what the price of carbon is that they're trying to take out of the inflation target. Now, that's a bit of an overview on climate change. And let's very skim on monetary policy, because I understand that many people here are central bankers. But central bank generally focus on either price stability or some goal on economic activity. And normally we have the debate about rules and discretion. What we see in the monetary literature is the best rule depends really on the conditions and the natures of the shocks. And so it's interesting to ask, well, we have a long literature on optimal monetary policy. What happens if you have a carbon constrained world and you have a climate disrupted world? And what we're what we analyze in this paper is simple feedback rules. And what we know from the literature is that monetary rules generally handle demand shocks well, whether you have inflation targeting or a Taylor, Henderson-McKibbin rule or some other rule, they generally handle demand shocks well. Where the problems are is when you have a supply shock, because that involves more trade-offs across inflation and output stability goals. And what we know from climate change analysis is that we're expecting a world with larger supply shocks, and this is a challenge for monetary policy. So what are the standard rules that are out there? Well, inflation targeting, price level targeting, nominal income or nominal growth targeting, or a Henderson-McKibbin-Taylor multi-factor rule. Each of these rules require a different amount of information and also require a degree of forecasting within central banks. And so the question we analyze is, well, does it matter in a climate changing world? So inflation targeting, very simply, we have an interest rate rule. The interest rate today depends on the interest rate yesterday, plus some weight on the gap between actual inflation and desired inflation. Flexible inflation targeting allows more flexibility than this. In fact, central banks that follow inflation targeting generally use an inflation forecast. So they're using the expectation of inflation in the future year, and they're adjusting interest rates based on their inflation forecast. Now, a good forecast of inflation is important in inflation targeting regimes as they're practiced. If we can't forecast inflation, then there's a serious question for that particular monetary regime. How important is energy prices in inflation? Well, I'm asking that question because clearly the different types of climate policies will have differential effects on energy prices. Here's some data for UK inflation, and the yellow line here is energy. And you can see that energy movements in the UK between 2010 and 2018 were fairly significantly dominated by fluctuations in energy prices. So energy price volatility is an issue for inflation rates. This comes down to the question then of, well, how do we do inflation forecasting in central banks? Well, normally we have a forecast of inflation as a function of the output gap. So here I've written the forecast of inflation next year is the desired inflation plus some measure of the output gap. If output is above trend, then we expect inflation will rise. If output is below trend, we expect inflation to fall. The problem is both Y and Y bar, both actual and targeted output, are highly uncertain. And if you have a bad forecast for either of those, then you're probably going to have a bad forecast for inflation. So the key issue that comes out of our work and other people's work is that over time, with these climate shocks and with this transition risk coming from climate policies, the output gap is becoming more uncertain and likely to become more difficult to measure and more to forecast in a climate impacted world. This is a key problem for inflation targeting central banks. Now, the other monetary regimes, I'll move quickly because of time. You could do a price level targeting regime, whereas instead of stabilizing the inflation rate, when the price level rises above some target, you actually drag the price level back. So this introduces a strong historical dependence. So not only when there's a supply shock would a central bank offset the inflationary impacts of a supply shock, but they would target monetary policy to be tighter. The change in prices and quantities, nominal GDP or nominal GDP growth targeting, two different approaches, very long discussion we could have on these. There's also the Henderson-McKibbin-Taylor type rules. So this is a general feedback rule where central banks might be targeting inflation relative to target, output relative to target, nominal GDP relative to target, some exchange rate regime, or a monetary target. In the Henderson-McKibbin version of this, we have a whole range of different policy rules. But if you zero out the coefficients on delta, gamma, and sigma, then you get back to a more conventional Taylor rule. So just to summarize what we know about monetary rules is simple feedback rules are a good way of representing central banks. And we know monetary rules can handle demand shocks well. The question though is how well can they handle supply shocks? Because we expect with a climate changing world, increased number of supply shocks as well as demand shocks. So key issue for inflation targeting central banks is that it's not just a one-off shift in the price level that we expect from a carbon tax. I've already shown you that carbon taxes generally rise over time in efficient policy, climate policy. And so we're going to have a jump in the price of carbon and a trend change in the price of carbon. So it's likely that you'll get an increase in underlying inflation and a new trend in underlying inflation. We also know that carbon price volatility is higher under a cap and trade policy than under a carbon tax or a hybrid regime. So now you can see that the choice of the climate policy has implications for the way central banks use monetary policy. The choice of the monetary regime will have impacts on how much the output losses might be under a carbon constrained world. Now, let me stress again how important the output gap is for inflation targeting. Output gap estimation is important for each of those rules, but actually less so for nominal income targeting. In a nominal income targeting rule, suppose your potential output is estimated to be 1% lower than you built into your rule, then by definition, inflation will be 1% higher if you achieve your target. So you don't need to have the output gap be exactly estimated to do a normal GDP rule. And so we expect, given output gap estimation to deteriorate under climate change and climate policy transitions, we expect that the output gap forecastability for inflation rules will be a problem. So now I'll just conclude very quickly. Let's take an example of a carbon tax, very simple. Many central banks have already thought about this. So what is a carbon tax? I've already said, it's a complex aggregate supply shock. It's going to increase input prices, so it likely will reduce output. Revenue recycling matters a lot. It could be pro-growth, it could be anti-growth, but we think that carbon tax will raise inflation and lower output. Now, let's do a simple example. If we have a 3% inflation rate, and every year we've had 3% inflation, and we impose a carbon tax at T equals 0, what do we get? Well, we get a graph like this. This is the price level. Year before the carbon tax, the price level jumps with the carbon tax. It's a one-off carbon tax, so therefore prices continue on the trend. You get a spike in inflation. Central bank looks through the spike in inflation, and then in the following year, that inflation spike is gone. That's what a conceptual simple carbon tax, a one-off shift, would look like. The trouble is, if you have a strict inflation targeting central bank, they would raise interest rates as inflation went up. That would lower output growth. It would appreciate the exchange rate, it would worsen exports, and it would bring inflation back down, but it would make a bigger output loss than an alternative monetary regime. A flexible inflation target would look through this, and then they would not raise interest rates. They'd tie down inflationary expectations, and they'd have to adjust the target with the carbon tax signal. And they've got to extract that carbon tax signal from the noise that's in the baseline. A price level targeting central bank would actually do a lot more than a strict inflation targeting central bank. They'd have to have deflation so that the price level comes back to where it was. And so you'd have to have a much bigger output loss. Now it's more complicated if, in fact, instead of a one-off increase in the price level, what if the carbon tax rises every single year? This is a shift in the inflation rate, as this shows here. This is much higher degree of complexity for central banks to look through. They've got to unravel the carbon pricing effects from the underlying baseline. They have to identify how much should they offset this and how much they can let it pass through. So what the conclusion then is that monetary policymakers are going to face more frequent, larger negative supply shocks. Inflation targeting central bank would tighten monetary policy to stem the rise in inflation. A flexible inflation targeting central bank would try and adjust for the transitory nature, but with terms of real-time measurement, it's hard to understand exactly how much of the adjustment you have to do to your inflation target. Price level targeting is probably more problematic for central banks because you don't want to necessarily go back to the original price level when you've got these shifts in trend inflation. And so we can see that flexible inflation targeting, strict inflation targeting, and price level targeting, it's likely central banks will make the impact of a carbon shock or a carbon price much more negative on economic activity. The HMT rules, they do the balancing more effectively than any of the extreme rules, and nominal income targeting, which only relies on a projection of nominal GDP growth, is likely to handle automatically any of the climate or carbon pricing shocks that would be passing through the economy. Again, with the nominal income targeting rule, the rule's simplicity gives greater credibility to the central bank. If output is higher than expected, inflation will be lower. If inflation is higher than expected, output will be lower. And I would argue that nominal income targeting or nominal GDP targeting anchors inflationary expectations within a bound, not at a strict point estimate, or because of the credibility of the central bank to allow inflation to be higher if output growth is lower. And so the hybrid policy actually works like a carbon tax. So from a central bank's point of view, they would really be much better if there was either a carbon tax or a hybrid policy. Problematic if you have emissions trading or if you have regulatory policies. Let me just give you a final example from the paper. Here's an example of a US carbon tax, $25 per tonne rising at 5% per annum. The price jumps in the first period and then it steadily increases at 5% per annum. What happens in the US economy under this example? Well, on the left-hand side, again, this is percent deviation from base. So this says that in year one, output would be 0.2% lower than it otherwise would have been under an inflation targeting central bank. So you can see the inflation targeting central bank achieves its goal. This is a pure inflation targeting, but the cost is greater output loss. So for a given carbon tax, you have much more output loss. You can see the flexible inflation targeting central bank looks through this and allows some higher inflation, but balances it with less output. And in this particular example, the nominal GDP targeting central bank has a better output outcome, but at the loss of higher inflation in the short run. And if you look at what happens in CO2 emissions, ironically, it's the inflation targeting central bank that has the biggest bang for the buck in terms of CO2 emissions. So you've achieved a much better environmental outcome, but at a much bigger economic cost. And so the central bank regime changes the nature of the relationship between the output changes and the change in CO2 emissions for a given climate policy. So you can see that the structure of the monetary regime and the structure of the climate regime are intertwined. So let me finish here. What we know is that we can expect to see more and larger supply shocks from both climate change through physical risk and through transition risk of different climate policies. Climate policies that induce predictable and transparent price signals will make monetary policy more transparent in our view. It's a delicate balance and it will vary across countries depending on the structure of the economies, the nature of their carbon intensity, the degree of substitution. But what we find, particularly for the US, is that nominal income targeting appears to be better than inflation targeting because we don't need to have a good forecast of potential output to drive our inflation forecast. We don't need to be able to understand the precise nature of the climate-related shock to look through in an inflation world because it will be absorbed in the trade-off, the automatic trade-off between inflation and GDP. And it does still anchor inflationary expectations to within a band. So it's not as if we're discarding the inflationary expectations that come. We're not discarding the anchoring of inflationary expectations that we have in the inflation rule. We're just allowing more flexibility in inflation given the trade-offs between output and inflation. But the bottom line is this very early work on this shows that it differs very much across countries, and there's a lot more empirical research is needed before we start moving towards away from inflation targeting towards some other policy regime. And many of these papers are at my website, sensiblepolicy.com. Thank you.
Thank you, Warwick. That was really a presentation with multiple interesting inputs to discuss. So I see there are a couple of questions already on the Q&A section. I would invite anyone else with comments or questions to write there. So Andrew McConnell, if you want, we can open the microphone for you so you can ask your question directly.
Hi, Warwick. Hi, Emmanuel. Thank you a lot. Thank you very much for the presentation. It was really interesting. You focus mostly on climate policies that involve carbon pricing. And I was just wondering what your thoughts are on climate policies that encourage investment, such as something like the Green New Deal, and how that might stimulate demand pull inflation, and how central banks have to maybe incorporate these kind of policies into the monetary policy framework, and if there might be a trade-off between inflation and output and investment in the end. Thanks.
Yeah, thanks, Andrew. That's a really good question.
Warwick, sorry to interrupt. You want to answer each question for itself? Do you want to pool some questions?
No, I think it's easier to answer as we go, because I think the questions look like they're jumping in a number of different dimensions. And I want to make sure that I can address the questions, particularly when they're as clear as Andrew's. I think there's three aspects of what you're saying. One is that there is actually a fiscal side to this coordination, and that's what I think is largely ignored. We have to worry about the climate regime, the fiscal regime, and the monetary regime. Now, in the World Economic Outlook work, which we've extended in a paper that's coming out any day from the IMF, is we looked at, instead of working out what carbon tax was needed to hit a particular emissions target, we said, let's put in place a green infrastructure program, and let's put in place subsidies to renewables. We put in place a whole vector of different plausible policies. The infrastructure program was 1% of GDP infrastructure for over 10 years. And then we worked out at the end, how big did carbon tax have to be to get to a net emissions by net zero by 2050. Now, without those ancillary policies, the carbon tax has to be reasonably high and the output losses are reasonably big. With the infrastructure and the subsidies, you end up upfront getting a stimulus to the economy coming from the spending of the infrastructure. You then get additional productivity benefits over time because of the way we're modeling the impact of infrastructure spending on productivity in different sectors. And so what you get is, with the infrastructure program, you don't get anywhere near as much abatement as you do with the carbon tax, but you get output gains rather than output losses. And so we give one example where we mix the two together, and we get most economies except OPEC and Russia get a stimulus up front because the infrastructure is big enough to offset the structural adjustments in the economy. But over time, the economies that are very fossil fuel intensive in their exports take an income loss which cannot be offset by the infrastructure program. This is very important because the economic costs of these transitions is changing the structure of your economy internally. Increasing costs of inputs causes output losses in the short term. But if your income is largely generated from exporting fossil fuels and the world moves to zero net emissions, countries like Russia, Australia, and OPEC, they get a very big income hit, which is hard to offset. So each country has a very different set of issues to address. And this is where the international coordination of this is critically important. It's not just how do you produce stuff in your economy, it's how dependent you are on income from fossil fuels. So I think that probably answers your question, but there's a lot more work needed to be done on the fiscal, monetary, climate coordination issue.
Thank you.
Thank you, Warwick. I see Rick van der Ploeg with a raised hand. So Rick, the floor is yours.
Thank you, Warwick. Many years ago did I speak to you, but there we go. Thank you for a very, very nice presentation. I mean, Warwick is, of course, one of the main guys looking at international monetary policy, international aspects. So it's very logical that you look at those linkages with climate policy. Could you say a little bit more about, well, we now live in a period with zero lower bounds. So people have often looked for maybe you're targeting prices rather than these other targets. Could you say a little bit more about it? And the thing I liked most was this, we know that central banks are looking more and more on forward guidance to try to help markets, forward guidance about future targets. Although that's important in monetary policy, I think it's even more important in climate policies. I think you've tried to argue. So maybe you could say a little bit more on those two things. And then related to that, there have been people arguing for independent central banks, independent carbon central banks. So that it's too important to leave to politicians. So you introduce an independent emissions authority, and they get given a clear mandate to get emissions down by so much, and they do whatever it takes to get that done. So could you say something a bit more about those general contexts?
Yeah, thanks, Rick. And again, our careers have paralleled very closely. And I think most of what you do, I agree with. Just on the independent central banks, I think one of the key problems we face is that just a mandate to hit a particular target in a particular year can be very, very costly, because there is an argument for smoothing adjustment over time. That's why in the hybrid approach, we give the central bank a medium-term target that they have to achieve, but any particular year, if the cost of hitting a particular target is too high, a company can come to the central bank's window and buy an emission permit at a fixed price for that year. And so it's similar to banking and borrowing in the carbon trading literature. It's really though the central bank has the mandate to hit the target over time, but the flexibility to allow prices to spike up in any particular period, or to actually go down in any particular period.
So I was thinking more that since your story was a lot based on pre-commitment and commitment. So imagine that you don't have it. Then you
I think
then an independent carbon bank might be a commitment device. But so
well, if you but again, the whole idea of creating these assets, it's like the barrow tying the hands of future governments. You create an asset which is distributed across the balance sheets of the entire private sector, households and firms. That pre-commits the government. That's a way to pre-commit the government. Excellent. They can always back out. They can always back out, but if they do, they destroy the asset. So you've got the liability we can identify. We've created an asset to match it, and then you have the balance sheets creating a political constituency which will help the central bank actually maintain the policy commitment that the voters, once they've received these permits, won't want to change. What's more important, I think, if I could just add, but what I think is really important is where we coordinate this across countries. My view is that coordinating across targets for emissions is a really bad idea, because a 10% reduction in country A can be very different to a 10% reduction in country B if their economic structures are totally different. So what we argue is once you put in place these systems in countries which are nationally managed, and you have a central bank's price of carbon, you could standardize and coordinate on the price of carbon in the annual market across the world. And so then you're negotiating what we call carbon price commitments. You convert all of the policies into a carbon price equivalence, like we do with trade. We can convert trade policies into tariff equivalents, and then you can compare like to like, and you can actually coordinate on the price. So if every country has the same price for carbon, there's no need to trade these assets across countries, because there are no gains from trade once the country has hit its short-term price target. So we want to turn the entire negotiation upside down and say, the quantity emission targets come from the science, you build them into the domestic institutions, you then coordinate at a common carbon price year by year, and that will bring down global emissions much more quickly than if you try and negotiate over whose target is going to be what, because you're trying to do the trade-offs between the emission reductions and the cost when you actually don't know what it will be ex ante. And so I think this is a way of creating markets to get the ex post equality and efficient outcomes for the world.
Thank you. That's a very exciting proposal. Thank you. I like it. Something on the zero lower bound? Something on the zero lower bound quickly?
Oh, okay. Yeah. So one of the issues, and one of the problems I have with, one of the problem with inflation targeting is if you get hit with a massive shock and you need to stimulate the economy, but you know the central bank won't let inflation go above a certain amount, real interest rates just can't fall very far. And so what we have, if you have a nominal GDP target, is that you allow inflation expectations to be unhinged within a band. Now, what this means in climate change terms is that if you can push the economy with a green infrastructure program, and you can actually start putting in place long-term carbon price signals, the demand stimulus up front won't be offset by the central bank, because you know the central bank's not targeting inflation. You know if output goes up or down, or inflation goes up or down, you're going to allow inflation to rise above that initial output loss coming from the carbon tax. And so that means you can get more real interest rate reductions at a zero lower bound, because you allow inflation expectations to shoot up. You know the central bank won't do something with QE or some other policy to offset that inflation spike. You want that inflation spike to give you a smaller output loss. Now, you can overlay that with this infrastructure program. It makes it more complex, but that's why I think you've got to get the fiscal monetary climate frameworks right, so that when you get the takeoff, the central bank doesn't prevent the takeoff from happening. It doesn't retard the innovation through higher investment, which ultimately is what you need to resolve the climate issue.
Thank you. So it sounds a little bit like doing James Mead, David Wine's type of nominal income targeting.
It does very much.
So I will tell David about this.
I think David might even be on the call, but yes, no, I've talked to him at length about it, and it was partly talking to him where some of these ideas might have come from.
Oh, okay, I'm not surprised. Yeah.
Great. So let me move to Marc Pourroy, that has also a question. If you want to open your microphone.
Okay, do you hear me?
Yes.
Yes.
Okay, so thanks a lot for the great presentation. It was really interesting. I was looking at a graph, and I was thinking the objective of the carbon tax is to reduce the consumption of energy goods, and therefore the weight of those goods in the consumer price index should decrease over time. So consequently, I think the price level sooner or later should flatten out and stop increase because consumption will change. So to raise a simple question, do you account for changes in the consumption basket in the model?
Yeah, I mean, yeah, no, that's a good question. It's a simple question because what we find in the model is that you're correct that in the medium to long run, CO2 emissions will be gone. And so there won't be any price trend at all because there won't be any carbon tax once emissions have gone, the carbon tax will level out. But the transition is decades. In this model, because we have putty clay technology on capital, it takes a long time for the coal industry, the gas industry, the oil industry, and the energy intensive industries that use those inputs to adjust their capital stock to get emissions down to zero. So within a time frame of 10 to 20 years, and in that graph I was showing you was largely 10 to 20 years, you still have a fairly big weight in these economies, unless you have a very large carbon tax, in which case you'll get a very large recession and you wipe out the capital stock very inefficiently. So you're right, but it will be a gradual, and the model takes that into account. But the real model, not the toy one I was doing a simple example on.
Okay, thank you very much.
Great. So we have 1 more minute left and 1 more question. Franz Nauschnick, please.
Yeah, do you hear me?
Yes.
Yes.
Yes. My question is, wouldn't it be more efficient to increase fossil fuel taxes when the prices of fossil fuels of oil or gas are falling, so as to avoid deflation? And also you do something very well for the climate.
Sorry, I lost connection.
Increase tax on fossil fuels.
Yep.
When their prices are falling, when the price of oil is going down from say $80 to $40 per barrel, you increase the tax accordingly, and this tax stays then. So you have a sort of minimum price for fossil fuels. So you avoid the question of deflation when the price falls very strongly. And this helps to stabilize it and to shift away from fossil fuels because they are more expensive.
Yeah, you could do that, but at the moment I would say inflation's rising rather sharply around the world, and so you can't wait until we have a deflation in fossil fuel prices to do these types of policies. We need them put in place immediately. And in terms of how, particularly oil markets, I mean, the question is, do the OPEC economies get the revenue from pricing carbon, or do the advancing or the economies that are importing that put the tax on to get the revenue? Yeah. So, there is a strong argument to be made for putting in place very clear price signals. I don't think I'd design my climate policy around some projection or some forecast of deflation, though. I would have a very clear policy, and if your world is correct, then it turns out the cost will be less, obviously. Well, not to OPEC, but the cost will be less to the countries that are importing the oil.
Great. So let me before we close, remind you that we have another webinar scheduled for Monday, June 28 by Stefan Hallegatt, who is the lead economist of the climate change group at the World Bank, who will give a talk entitled "The Real Economic Impact of Natural Disasters: Accounting for Distributional Impacts and Implications for Poverty." And for the next webinar, the time will go back to the usual one, that is 12 Eastern US time and 6 p.m. CEST. With that said, let me thank Warwick, our speaker, once again for the great talk, and all of you for attending. Thank you, Warwick.
Thanks very much, Manuela. Thank you very much, and thank you for the questions. I can be reached by email if people want to follow up. Thank you.
Thanks.